Hello and welcome. Thank you for joining us today. My name is David Widmar, an agricultural economist at Purdue University in the Center for Commercial Agriculture. And today I'm joined with Dr. Michael Langemeier, a professor and associate director for the Center for Commercial Agriculture, and Dr. Michael Bolge, a distinguished professor in the Agricultural Economics Department. Today we're going to be talking about the agricultural economy. We'll be featuring results from the latest survey from the Purdue University CME Group Ag Economy Barometer. Just as a reminder, this is a survey of 400 agricultural producers over the entire nation. We've been doing this monthly, and this is our second webinar featuring the results. We also have on our website, which is purdue.edu/ag-economy-barometer, the latest results from this survey, as well as the historic ones. Today, through the webinar, you're welcome to email any questions that you might have. The email address will be periodically shown along the bottom of the screen. So we encourage you to email those questions to us. If we're not able to get to them today during the webinar, we'll follow up later today or tomorrow to your emails. So before we dive into the results, Dr. Bolge, would you like to talk to us about the last few months in agriculture? It's been quite an interesting ride here for producers. So what's been going on?
Well, certainly we see a lot of volatility. Volatility is just kind of facts of life for the industry, but we've seen some things happen recently that are pretty relevant to the timing in which this last set of survey results were obtained. So we've seen prices pretty well declined fairly dramatically, as this chart indicates, since June and into July. And then we had a little bit of a run-up, kind of a recapture, and this survey was done there in that period of July, where prices, after some recovery, had been coming back down a little bit. And so this puts the results in some context, David, because we've got some interesting kind of disparities, it seems to me, in the results, which you're going to share in a second, in terms of how people view where we are, current environment, as well as kind of what they have as a perspective in terms of the long-term future. And maybe for those of us, at least the ag economists, some of the results are, I wonder why they're thinking about it that way, right? So I just want to make sure everybody understands the context and remind people of the context. We came off of some 450 kind of prices down into that 340, back up to a recovery up to about 380 there for a period, but this was done then after we started showing some softness in terms of that partial recovery from the high price point. So that basically says, okay, where are farmers at now and what's their expectations? So let's see what they told us.
It's a great point. The survey was conducted the third week of July, or the week of July 18th, and corn prices were definitely stronger then than they are today. So we've seen some further erosion. As we're going to talk about, that movement down gets particularly painful when we look at the cost of production side of things.
Right.
So let's take a look at what the Ag Economy Barometer results were in July. So in July, we had a value reading of 112 points. That's up from 104 in June, and the third consecutive month we've been up since May. This is also one of the higher barometer results we've seen since we started recording data back in October, since we've been collecting data since October. So October, we set the high of 116. Kind of a tough winter as producers prepared their tax statements, started visiting with their bankers, saw commodity prices slide. We slid down to 85 back in March. That was right before the USDA released that very bearish report that sent the market quite lower in March. Then we rebounded, good favorable planting conditions, and we've kind of been ticking upwards throughout the summer months, especially.
So see, that's really again makes those of us that are kind of looking out there longer term kind of wonder what this is all about, because we see, even though prices have been kind of declining during this period of time, as indicated by the previous chart, this suggests that the survey suggests the barometer's headed up. So there's got to be something underlying this that means that guys like Michael and I, who can't quite figure this out, you help us figure out why it's going in that way, because that seems a little bit counterintuitive,
that
right?
Seems a little counterintuitive.
Yeah.
A lot of observers are going to be surprised by these results to see that such a slide in commodity prices, more than $1 in corn since mid-June, but yet the sentiment actually rose up. But to dig into this, we have two subcomponents in this Ag Economy Barometer. There's a look at current conditions, what's going on today, and then there's a long run view of future expectations. And we're going to look at that data here. In brown is the index of current conditions. In the green turquoise color is the index of future expectations. Current conditions really looks at today, this short run view. That index looks beyond today. One of the questions asks, how do you feel about conditions over the next 5 years? So it takes a longer run perspective. And what we saw happen from June to July is the index of current conditions slid from 98 to 93. Okay. That is in line with what we would have expected with the commodity price falling. Producers aren't going to get as strong of a price for their commodity, their corn, soybeans, wheat. So that's going to make financial conditions a little tougher this year. The surprise, I guess, in the data was that this jump in the index of future expectations from 107 to 121. That was the strongest value we've seen out of that specific index since October 2015. And there's a few data points out there that we're going to talk about in the next few minutes that really support and underpin this producer optimism building towards the future.
So that's about a 10%, roughly 10% increase in that index in terms of the future. So there's quite a bit of reflections of optimism there. And the barometer basically is a weighting of these two, right?
Weighting
and
of these two, yeah.
That the longer term perspective then kind of overweighted or overshadowed the short-term downturn. And the downturn was only about 2 or 3% compared to 90. And so that's why this barometer is going up rather than flat or down. It's an overall barometer.
Yes, that's when we dive into this, we do see the divergence there in this current versus future. And overall, the future jumped so much it pulled the whole overall index.
Right.
We won't dig into the methods too much today. On our website, we have a section devoted to that and a video. It's, again, purdue.edu/agbarometer. There are 5 questions that really go into this index. 3 of them are looking at the future. 2 of them are looking at the current conditions. And so that's how we derive this. And there's a lot of detail out there if you want to look at the specific questions. But getting a little bit into the questions that start to underpin this survey, we asked producers monthly, do they think that the general ag economy as a whole during the next 12 months will be good times or bad times financially? We're showing the data here for percent of respondents saying bad times. What we've seen is that since April, that's gone between 70 and 65%. So it's trended pretty flat. Not a whole lot of change in how producers are viewing the 2016, early 2017 timeframe. Where we do see a divergence is on the longer term picture. Very similar question. Now the time frame is during the next 5 years. Do you expect widespread good times or bad times financially? Again, those show reporting bad times are shown. Since April, we've seen that pessimism decrease. We saw 60% saying bad times back in April. Now we're down to 40%. So this is really part of that. These 2 questions go into the barometer score themselves. So this is what's kind of driving that future expectations are actually improving for producers.
Yeah. So maybe at least the perception here, is it fair to say, David, is that, okay, maybe things are in fact in more of a bottoming out kind of mode. We're seeing the kind of this maybe flatten out type of thing. At least that might be what's being suggested by this kind of number, that at least that's where producers' perspective is.
That's certainly going into this, definitely. I think the other thing that's going in is that we saw $4.50 corn, nearly $12 soybeans. I think producers saw, okay, if this is closer to the bottom and that's closer to the top, that top's getting to an environment where we're getting close to economic break-evens, maybe even some economic profitability in some parts of the country. And Michael is going to talk a little bit about that later.
A little later, we'll show some projections related to net returns, and following up on Mike's point, 14, 15, and our projections for 16 are some pretty large losses for crop producers in particular. And so this is relative. You know, if you're looking at that as kind of where we've been, there's optimism that we could be better than that. And I think that's where they're coming from. And as we'll see here in a little bit, when you look at the long run price projections and you combine that with cost projections, it looks like we are going to move towards break even in 2018, 2019, and so I can see where they're coming from on this particular graph.
So one of the important drivers moving forward in the ag economy is where do we end up with commodity prices? What is the kind of average that we can expect in commodity prices. One of the questions we ask within the survey, we ask this periodically, is what do producers expect for commodity prices 12 months from now? The data presented now are the share of respondents expecting higher commodity prices a year from now. And so we see this at different time periods. Back in October we asked this question. We asked it throughout the spring, and then we asked it then again in July. And what we saw in July is, take corn for example, 23% of respondents expect higher corn prices a year from now. That's the highest level we've seen since back in January. So even in the spring, fewer producers expected higher prices than today. Similar story with soybeans. More producers expecting higher commodity prices than we saw in the spring. In wheat, which has been in really tough conditions with low prices, the largest share of respondents, nearly 25%, expecting higher commodity prices a year from now. So thinking again to this future, the rally back in June, looking into the future, producers are thinking that higher commodity prices are more likely in the future.
Yeah, and so we were at kind of, when the survey was taken, if you think back in terms of that chart, when it were down at lower prices, but it was less than, 30 days prior to that, they'd seen these better prices up here. And so they said, okay, that's achievable, they can happen type of thing. And so even though we might have expected them to say prices are going to be lower, they may have been reacting to the fact that there is upside potential here, and this was a reason to, and it hasn't been that long ago where we saw that upside, and so higher prices are in fact reasonable to expect going forward. We're, again, I don't want to push this too far because we don't know what's really in their minds, but maybe they do believe that we're in a more of a bottoming out type of environment with some uptick potential.
Just to add a little bit to that, if we think back in March and April, the projected price, crop insurance price for corn was $3.85. And so, to think that prices are going to rise above that is harder, I think, to expect that to happen than where we were when this survey was taking place. This survey was taking place, I think the range was 340 to 360 in terms of the futures price. And so, it seems logical to me that you would expect, there would be more people expect prices to increase where we're at in July compared to where we were in March and April. Simply because the reference price is different.
Good.
So another part of the survey that we ask about on a regular basis that I think helps support this optimism towards the future, this strength in the expectations of what the next 3, 4, 5 years might have, deals with farmland. Farmland is important to producers. It's a large asset base for a lot of producers, represents a lot of retirement and savings. So we ask producers what their expectation of farmland values are going to be, again, 12 months down the road. We've asked this survey question back through November. We have several data points here that on the screen. And there's two data points we're showing. In gray, it's those expecting higher farmland values. And in brown, it's those expecting lower farmland values. So those expecting higher farmland values was about 12 to 15% throughout the spring and last fall. In July, we saw that jump up to 23% of respondents expect higher farmland values a year from now. In brown, those expecting lower farmland value price, that has settled lower, down to 25% in July of this year, up close to 45% earlier in the spring. So we're seeing the share of producers who think farmland values are going to be higher increase, and the share of those expecting lower farmland values to decrease. Of course, 50% or so of producers think they'll stay about the same. But here on the ends, we're seeing a shift towards a more favorable outlook of what farmland values might be down the road. And I think that's an important signal when we think about the health of the ag economy.
So again, just want to emphasize in some sense the consistency that we seem to say. And so sometimes when you see things, you worry about the fact, well, they're saying something over here and something different over here. Again, this is kind of consistent, where in fact it does suggest that at least the anticipation of the producers responding to this survey is we're in kind of a bottoming out type of phenomenon. So we see going from a lot who thought, these prices are still, farmland prices are still going to be going down, almost 45%, Now we're down to more of a balance on those tails, if you will,
Yes.
in terms of how many think it's going to go up versus how many are going to go down, compared to being out of balance where there was a much stronger orientation on the part of those saying these prices are still going to be going down in November of last year.
This is one of the most surprising results of the survey, at least for me, because it's a short-term, long-term expectation. So that's probably, I'm probably thinking more short-term than perhaps the survey respondents here. But if you look at the rest of 16 into 17, net returns for crop producers are not going to be very good.
Right.
And so they must be looking ahead.
Yep.
We know they're not going to be very good here for the next 12 to 24 months, but looking ahead, things look a little bit better. They must be looking ahead when they're answering this particular question.
Right.
That's the only thing they could be doing, because the next 1 to 2 years are still going to be pretty tough when it comes to net returns.
So we just completed recently, Dr. Craig Dobbins does annually the Purdue survey of farmland. It's a look at values and cash rental rates. Some of the results he shared at Top Farmer a few weeks ago is both farmland values and cash rents down around 10%. Varied by soil quality, but across the board 10%. So part of this is we've already started building in some downward movement in farmland values and cash rental rates, depending on where you're at in the country. I also want to mention that in a couple weeks, in August 17th at 9 a.m. Eastern, Dr. Craig Dobbins and Dr. Michael Langemeyer will be again here in the webinar studio talking about those farmland values in a lot more detail. We're going to spend a lot more time on that. So mark your calendars for that. You can register on our website. But I just wanted to make note that optimism for that future has been growing, and part of this is this underlying support in the farmland values expectations for the next year. So more about the current conditions coming up on the 17th. So one of the important things that we've kind of mentioned a few times in conversation is that there's been an improvement in the cost of production structure. So we're not back to $6 corn, but we've also worked our costs of production down to where we get to $4.50 or corn, or $11.50, $12 soybeans. We start to see some economic profits growing. So I'm going to spend some time talking about that and looking at some of the data as we think about the rest of 2016 and looking into 2017. And this can help support what might be going on in producers' minds. One of them is fertilizer, cash rents, and then just general fuel and energy. And a little bit on equipment. We're going to talk a little bit in the next few minutes. So Dr. Langemeyer, could you speak a little bit about what's going on within the crop budgets?
Yeah, this is actually budgeted costs, and so it's very important to point that out from the Purdue Crop and Return Guide. And I want to focus on 14 because that's when we transition from being fairly profitable to not so profitable, going from 13 to 14. And since 14, we've chopped about $50 to $60 per acre off of corn costs for kind of average productivity land. About half of that's coming from cash rent and the other half from fertilizer. Seed and pesticides, we had very little change in terms of those two things. But again, this is a pretty sizable drop when you look at this historically.
So Michael, if you think about, you said $60
$60
per acre. Sorry to kind of continue to hammer on this issue, but if you look at the yields that you had in these numbers, what kind of cost reduction per bushel do you think that just roughly works out to?
Per bushel here, Mike. Oh, gee. Thanks, Mike. Probably.
Sorry, I should have warned you.
No, it's probably about 25 cents to 30 cents.
25 to 30 cents per bushel come off. Off
and so when you let's look at high productivity soil, the break even right now for 16 is right down there around 4 to 410. That was closer to 435, 440 back in 14. So it's quite a bit.
That's right.
Particularly on high productivity ground, we're getting closer and closer to that long run projected price.
That's right.
A lot of projections have corn going under 4, but getting fairly close to 4 as you look out several years. And so at least on high productivity soil, it looks like we're getting closer to that $4 mark.
Right. So I mean, I think what's really important here is that if you think about what's happening, we actually are getting some cost reductions to be able to get us back to less red ink and more black ink, right?
Yeah.
And this is also, I mean, this is always the story I always have to worry about is, okay, let's make darn sure we don't give up inputs that are going to result in lower
Definitely.
productivity, lower yields, right? And so that's why we continue
Yes.
to kind of work back to say, let's make sure we think about this as well in terms of cost per bushel as well as cost per acre.
So to reframe this a little bit differently, $3.75 if I'm selling corn today
Yeah.
is not great, but it's very less painful than it was
Yes.
in 2014.
Yes.
So we're seeing some improvement. So that's why producers can get pretty excited when we start talking about $4.25 futures prices that we saw in June.
And you combine that with very high yields that some farmers are probably going to have this harvest. It does give you some optimism.
Right, that's right, that's right.
And one of the points you mentioned is that we've got $60 an acre, 25 cents a bushel worked out. Well, that's coming primarily from cash rent and fertilizer. Do you
Yes.
want to talk a little bit more about that?
Let's go to fertilizer here. Fertilizer prices, of course, have dropped substantially. Here we're looking at mid-July and from 2015 to 2016. You can see anywhere from 20 to 32%. Depending on the product you're looking at. So very large declines in fertilizer, and so that's why we're seeing a pretty big drop in fertilizer cost per acre, but seed and pesticides really haven't changed all that much. And so those are three of the big cost items besides some of the overhead costs, and of those three, fertilizer's the cost that's really made some adjustments.
So let's just take a second and think about this, Michael. These are farmers' prices are paying for
this is retail
fertilizer at
prices.
retail price,
Yeah.
right? Okay. Now, some of the anecdotal conversations we've had with people in the industry suggest that that retail prices this last year, 16 compared to 15, didn't adjust down as much as wholesale prices did. But most retailers had pre-bought their fertilizer, and so weren't able to pass those lower costs through that they might actually had when they booked their new fertilizer for sales in 17. So in fact, I've heard some people say as much as half of the price reduction was actually passed through, and there's going to be the potential for some additional reduction next year. Is there some?
I think
is
there's
this
some.
just pure hope, or is there
I
some
think
possibility?
I think there's
of
some
this?
uncertainty with respect to this market, just like there is for corn prices. I think it really depends on the corn-soybean mix in terms of acreage. I think there's a lot of factors that play there. But be conservative when I'm creating the budgets. I've assumed the fertilizer prices are going to stay where they're currently at.
Okay.
And so there could be some reduction in cost from what I'm showing here if prices have further decline.
Yeah. Okay. So your 17 numbers are really
Yes.
built on though.
Yeah.
Let's don't build that expectation
Yeah,
and
I'm
be
building-
disappointed if it doesn't occur.
I'm building flat,
Yeah, okay.
0% right
Okay.
now.
Okay. All right.
Let's see what the producers thought here.
In the July survey, we asked producers what their expectations for fertilizer prices a year from now. So thinking about what they might be seeing this fall for their wheat and early fertilizer application on the corn, and then again in the spring. Do they expect prices to be higher, lower, or about the same? Third, 34% of producers expect prices to be higher, 13% expect fertilizer prices lower, and the balance, of course, are at about that same range. So. In general, I think producers are looking at this saying, hey, we got a good run out of lower fertilizer prices. We could see some strengthening in those prices moving forward. I think to Mike Bolge's point, there's maybe some opportunities to pass some additional savings through the supply chain. But I think on the other side of the coin, we had a very large planting of corn acres this spring. So that used up a lot of fertilizer that was out there. So it'll be interesting to see how the fertilizer market moves forward, especially given the large share of total cost reduction that fertilizer has provided to producers in the last few years.
Yep. So the other thing here, we're talking here about prices now.
Yes.
And some farmers, Michael, have done some adjustment of the fertility program as a way of trying to reduce their cash cost in terms of, particularly in terms of reducing, say, P&K applications. That's probably going to be a little bit hard. I mean, you can only do that for so long. You've got build up reserves. You probably can't do that every year, right?
I would think that'd be pretty difficult to do that more than 1 year. To drop those P&Ks substantially.
Right.
And I know some producers did that, but you've got to make sure there's adequate P&K in the soil, or you're going to have a yield reducing impact. So you're right. I think there's going to be less management maneuvering ability coming into the 17 season compared to 16.
Right.
So in your budgets, you've assumed a constant
Yes.
application rate,
Yes.
and you're accounting for price reductions.
Our costs are strictly have to do with price
So
adjustments.
at the farm level, producers who have soils that are in good shape, fertility-wise, have been able to take advantage of maybe holding off on some P and K applications to help in this tough economic situation.
Yeah. But that's in a sense a kind of a one-shot deal.
Yeah, limited
Maybe a
term.
little bit more next year, but you can't do that. That's not a permanent fix.
Not a permanent fix. Not a permanent fix. One other question that we ask on a regular basis that goes into the Ag Economy Barometer scores, we ask producers to think about large farm investments, maybe buildings, machinery, grain bins. Do they think that now is a good time or a bad time to make such purchases? Now, of course, good times and bad times has a couple different connotations. One of them is prices, and one of them is the financial situation producers are in. Right now, we're showing the percent of respondents saying bad times, and so this has been pretty consistent over the last several months. We've been trading, at least the last few months, around 70% of saying bad times. Now, if you're in a good financial situation, there might be an opportunity to take advantage of some prices.
Yeah, so this is really, I think, an interesting chart in that it basically says, and we see it out in the countryside. I mean, people in the capital goods industries have been struggling with sales, moving product, had to discount prices to do that, and this is pretty consistent with that farmers are still in a holding back mentality in terms of wanting to make those capital expenditures. They can't make as much adjustment on fertilizer, seed, and chemicals, but they certainly can, Michael. If they've got cash flow and other financial pressures, they can say, okay, we can hold off on the capital items. Now, the other side of that, however, is that for that farmer who has a very strong working capital position, strong financial position, and maybe didn't modernize during the last 5 years or so with new equipment and machinery, et cetera, there's also some pretty good buys out there in this market, particularly in machinery and equipment market, as well as some products coming off these leases. There's some pretty lease arrangements, attractive lease arrangements as well. So it's going to be really important if you think about the managerial implications. This is really important for the dealers in the agricultural manufacturing equipment industry to see these types of perspectives, because it says, okay, we better not ramp up and start putting our factories back on schedule, because there's just not that much optimism out there in terms of the buying side of this, in terms of everybody needing some new equipment or wanting to put a new bin in place. But on the other hand, there are individuals that might very well find some pretty attractive deals with the lower prices that we've seen, particularly in the machinery equipment space.
Especially those who find themselves in good financial
That's exactly
condition.
right. Very important. We always say, make darn sure you don't destroy your working capital position to try to get that new technology. You might got it new, but you won't be able to take it to the field.
And this would be, I know, Mike, you're talking about people that are beyond the minimum threshold for working capital. Even people with moderate levels of working capital, well above the minimum thresholds, had to be very cautious about working capital. And I think that's what this graph is presenting. Is representing. Is those folks know that they have to be very cautious, because working capital is really our first stop, against financial losses. And if we think there's going to be financial losses in 16 and 17, we're going to need to keep that working capital close to us so that we can cover those losses from a cash flow standpoint.
So we maybe not done. Well, your numbers are showing we're not done with the potential burn rate on that working capital we've got. And so we've got to have a bigger cushion, a bigger buffer than we might have thought in normal times when you didn't have this burn.
Now, fortunately, the average working capital is pretty strong out there, and so fortunately, we're in good position to kind of weather the storm. At least a large percentage of the producers are, and so it's nice to be in that situation where you can take advantage of a price opportunity on machinery if you want to.
Right. Yep.
So we spent some time talking about equipment, fertilizer, land values, and cash rental rates. Let's put this all together into the budget, Michael. And what can we learn from looking at the budgets today and looking down the road?
As I was talking about earlier, 14 and 15 were pretty tough years. This is West Central Indiana. Remember, West Central Indiana, we had very low yields. in 2015 because of the very wet conditions in June. And so kind of keep that in mind when you're looking at this chart. But also 16 and 17 don't look real good. I mean, this is the relatively low prices right now, and our cost structure hasn't adjusted completely. And so we are looking at some losses for 16 and 17. But going into 18, 19, and 20, there's room for optimism. We're getting much closer to the break even there. This is fully loaded costs, and so it's very important to note that. And so opportunity costs are included. I would like to note here that I do have some possible reductions in cash rent built into these forecasts. I don't think the drop in cash rents, at least in Indiana, is done. We've dropped about 12% since the peak. That's smaller than Illinois and Iowa, slightly smaller than Illinois and Iowa. But I have included another 10 to 15% drop in cash rent in these figures. Of course, if those further drops do not materialize, it won't look quite this good when you get to 18.
Now, let's make sure we kind of look here at 18. So in 18 specifically, what have you done about government program payments? Because there's probably not going to be.
I'm assuming there's not going to be any.
Not be any.
Yes.
Okay.
Even 17 for West Central Indiana, there's likely to be a zero government payments
in the ARC program.
Yes, in the ARC
program. And that's just simply the mechanics of the program that adjust those payments down if prices continue to be at the point they are. The Olympic average would throw out one of the higher prices and replace it with a lower price.
For this case form, there was payments in 14, 15, and likely to be payments in 16.
Yeah, okay. So it isn't because you're just trying to get rid of government payments. It's just the way the rules of the game are, right? But actually, just to make sure, this is a small point, but actually it could be important, they actually might get a check in 18, right? But it's because of what happened in 17, right?
Yes, it's a whole year behind in terms of the
government
check.
Payments are a whole
17 in particular is worth talking about because we're likely, a lot of farms are likely to get a payment in 16. That'll come in October 2017.
Right. And so your budgets
Yes.
really put the payments in where they are
the year of
attributed,
production.
not when the cash is actually
with the year of production.
received.
Another thing here, we don't want to get it too far into the weeds, David, but this chart kind of excites me a little bit. You'll notice here 13, 14, 15, and 16, soybeans actually had an advantage in those particular years. And that was before the run-up in prices that we saw this year. As you move further along, that starts to disappear. But you'd expect that with projections aren't going to project one crop as necessarily better than the other. But certainly that advantage that soybeans had the last 3 or 4 years seems to disappear when you're looking at projections, long-term projections.
I think it's also important to point out kind of the difference between economic cost of production, economic returns, and accounting cost of production and accounting returns. When we get to 2018, there's probably, a $20, $30 economic loss.
Yes.
There's a strong possibility producers will be having a tax bill at returns at those levels. So accountants or economists like to assign full cost. This is a long-term return on all your assets and all your time.
It's particularly true for those that own a relatively large part of their land. Here we've included a cost associated with owned land. Accountants would not. Also machinery. If you own all your machinery and equipment, here we've included that cost. Ownership cost, where accounting, you'd include the depreciation, but you really wouldn't include the full economic costs associated with the machinery. And so yes, there's a lot of differences there.
Well, and at the same time, there is this other difference, and that is that because they are in fact opportunity cost on land and machinery, we don't, and not cash cost, our numbers that you're reflecting are full economic, fully loaded cost of production, and therefore some of them being not writing checks for cash. It just means that I'm going to have to take less money for my time, energy, and effort, which I'm going to, or get less paid back from my land or machinery than I would otherwise. And that's a really important thing for us to understand. Agriculture has a fairly significant, most farmers, unless they're very highly leveraged and or rent most of their land, they have a fairly significant amount of absorptive capacity to handle these lower incomes and some of these losses. It's not as though it's actually going to be that they actually just lose that much cash. They are just not going to be able to recover as much income to pay themselves, which they don't write checks to themselves typically anyway, for their time or for their land or those types of things.
I think that really speaks to why, thinking about the next 4 or 5 years, where producers are starting to get some optimism building.
Exactly.
We've seen commodity prices reaching some highs that we might not have expected to reach at 450 corn recently. We've seen the cost structure come down, and that's projected to continue closer to 2018, 2019, when we return to the kind of economic break-even standpoint.
Right, right.
So kind of shifting gears here in our last few minutes. In addition to surveying the producers, we also surveyed a couple other groups in the month of July. The first group is our agricultural industry thought leader groups. This is about 100 ag thought leaders that are ranging from bankers to input suppliers to consultants all across the supply chain who deal with producers. And we asked them about what they're observing about at the farm level. We also surveyed fellow ag economists. The recent AAEA, or the meeting of ag economists, happened in Boston earlier this week, and we have a survey results from asking them similar questions as to what they think is going on in the ag economy. So one of the key results that we wanted to focus on from the thought leaders is what thought leaders are thinking about when it comes to farmland values. And this really is a replication of our earlier results with the producers. The share of thought leaders who thought farmland values would be higher a year from now was essentially zero back in November, and that has increased over time. It crossed the 10% mark there in July. So more than 10% of the thought leaders are expecting higher farmland values. On the other side, we've seen a decrease in the number expecting lower farmland values a year from now. In November, we saw almost 80%, and today we're below that 40% mark. So still a little more pessimistic about farmland relative to producers, but the trend has been towards...
The direction is the same.
The direction is the same.
Or lack of pessimism, if you want to say it that way.
Lack of pessimism about where we might be looking a year from now.
Yeah, right.
Back in November, this group was pretty darn confident that farmland values were going to go down.
Right.
And we've seen that in the last few months, but now we're seeing a little bit of a shift. Not quite as much expecting that, not as much conviction in that direction. We also want to look at some results that look at the AAEA survey results, or the ag economists across the country, and we present these results kind of as relative to the producers. So we asked them the same...
Now you got a mistake on that slide, that red bar there.
That's too low.
That red, is it red because you're trying to make darn sure that we are embarrassed by that, or what are you trying to do here, David? Okay.
That was somebody else who made the mark, but I don't know what their motivation was, but I can just here report the data. I don't know the implications of the color. So we asked the same 5 questions that we asked producers, and we took those results and we kind of said, relative to producers, how does this group look towards the future of the ag economy? So the ag economist group from the AAEA survey was at a value of about 79 relative to that 112. Of course, we only asked that data point in July, so we don't have that time series to compare it to. So those of us, I guess, including us around this table who look at this on a regular basis, we have some concerns, not as much optimism. And of course, as we did earlier, we can digest this a little bit and dissect it into that current versus future expectations. And we did the same for that survey result. So in brown, and in the brown circle is the index of current conditions, the ag economists and the producers are relatively the same. They feel about the same when it comes to what's going on today. The big divergence here is about where the future is heading. Producers, I guess hope springs eternal for that group. They're really looking down the road, and they're feeling pretty optimistic about where the future of the ag economy might be going. The ag economist groups, there's a lot of concerns as to, in their minds, I guess, where commodity prices and producer returns and what's going on out there. So I thought this would be kind of an interesting set of data points to line up with what's going on in the field for producers.
So I think this is really an interesting perspective in terms of the difference between the current and the future. And I think, Michael, I think we ag economists do have, I think, concerns about the future. We see this inventory build up, and actually maybe, and there was a little bit difference in the timing on this or not.
About a week.
About a week.
They're within a week of each other.
Yeah, okay. And maybe there is this thing going on. The markets were in kind of a downturn for both groups when the survey was happening, but I think maybe the ag economists, I don't know, didn't ask them what's in their mind, but maybe they're just naturally pessimistic people is one possibility. But the other possibility is that they saw this market stabilizing down at a lower level in terms of commodity prices, and they were worried that maybe that recovery phenomena isn't going to be what they would like, or maybe what the producer groups like. Pretty hard to kind of figure out why there's this very significant difference between the two, but it'll be interesting to see whose expectations for the future actually come true, right, Michael?
Yes, that'll be very interesting.
I guess we can all agree about the current
That's right.
situation.
That's right.
It's the lens of the future that we're a little bit disagreeing on. So,
Yep.
And it goes back to a little bit, how you're thinking about the future, whether you're focused more on the short term, maybe the ag economists were focused more on the short term, or you're looking at 4 or 5 years out.
Right.
That question can be interpreted a little
That's right.
differently depending
That's right.
on who answers that question.
That's right. That's right.
Because I can be pretty pessimist if you're looking at the next 2 years, but you're looking at 3, 4, 5 years out, there's room for optimism.
Yep. Yep.
and the timing can be really
Yes.
critical. We can move that just a little bit and really adjust that. So that's all the time we have for today. We'll definitely respond to the emails that we have in here that we didn't get a chance to get through on air live today. We encourage you to visit our website. You can do a search engines lookup of us at Center for Commercial Ag at Purdue.edu. You can also read more about the Ag Economy Barometer at Purdue.edu/Ag Barometer. And again, we invite you on August 17th to join Dr. Michael Langemeyer and Craig Dobbins at 9 a.m. Eastern to learn more about the Purdue survey of farmland values and cash rental rates. Thank you on behalf of the Center for joining us today, and feel free to reach out with any future questions. Thank you.